Welcome back. The Diwali special continues on money, money, money. So, NILESH, I'm going to go back to the conversation we were just having. You gave a couple of ideas about, pockets which look interesting in the market. Is that going to translate into a lot of thematic fund ideas, perhaps this coming 12 months? Should one be looking at sector funds at all?
Thematic funds are like deserts. It should be consumed only along with your normal meal, and you should not overeat it. So, in a very simple manner, unless until you are an expert in investing, please don't go for thematic funds. They could be high risk, high return.
Ashish, we remember the bloom of the sectoral and thematic funds back in 2007-8, the infrastructure funds, the power funds, and we all know what happened after that. Your thoughts in looking at the current products which are in the market?
So, I'm a big proponent of keeping it simple. I mean, allocating it to managers based on styles, because if you have a portfolio built with managers of different styles, you automatically get diversification across different themes and sectors. But however, for let's say sophisticated ultra HNIs or HNIs who want to spice up their portfolio with some thematic funds, I think it's very important to have a philosophy around your thematic allocation.
Sure.
So if you believe that the thematic allocation needs to be contra in nature, because a lot of times fund managers, need to maintain public track records.
Yeah.
So there are themes or sectors you wouldn't see in diversified equity funds. So something like an IT or a pharma today, which is kind of fallen off the eyes of the investors, and a lot of the pain is already in the price. So if you want a thematic exposure and the philosophy is to have a contra exposure within the theme, then something like an IT and pharma looks quite interesting at this point in time.
But only for the slightly higher risk appetite investors and more sophisticated
It's not
investors.
for the faint-hearted. I mean, it's for the sophisticated investors who don't mind even if the call on the theme goes wrong.
Sure. So now coming to the point of how to gauge your equity portfolio's performance. You gave us the basic benchmarks, Gaurav, a while back, that you're looking at 15-16% annualized over a long time period. But my critical question is this, NILESH. While we all know that equity is a long-haul story, it's a long-term investment, when do you realize that maybe this fund is not doing what it should to my portfolio? So maybe I need to either talk to my advisor, or if I'm doing it myself, then I need to start thinking of alternatives. When does that point arise?
So there are two ways of taking your profit out or cutting your losses. One, from an asset allocation point of view, if you are too much overweight into a particular asset class, if markets have corrected big time, your equity portion will come down, your fixed income would have gone up. It's time to restore the balance by selling fixed income and buying equity. On the other hand, it could be in relation to your component of your asset allocation. So I invested in equity, but that stock is not doing well. Now I have to take a fundamental call. One thing we must remember is that form is temporary, but class is permanent. There are always bad days in the life of a stock picker as well as fund manager. But if your fundamentals haven't changed and prices have come down, valuations have become cheaper, it's time to double your bet. It's time to add more rather than cut your losses. It's your ability to buy at lower level, averaging down below, which gives you, better return opportunity. So at the top level, look at the asset allocation. Whenever it is in imbalance, restore it. At the bottom level, look at the components. Whenever the fundamentals change, it's time to book your profit or cut your loss.
Gaurav, what is your thumb rule when you decide that, okay, it's time to now make a change in someone's portfolio? This fund needs to go and I need to maybe replace it with something else.
So what we do is we kind of, internally we keep evaluating funds on weekly basis or something, but we don't change portfolios sometimes even for years. What we start looking at is that when we constructed a portfolio, so if it had some large cap, mid cap, index fund, whatever, first we look at that, is that fund adhering to its philosophy? So if a fund says I'm a large cap fund, there are certain statistical parameters and the benchmark they have given in the document, are they adhering to it? If they are, then we'll still give them time because the benchmark itself is underperformer. Then we look at peers and how's that fund performing. And then at some point of time we may decide that stop SIP. Does not mean that we take it out. So that's
you just stop further investments.
Stop further investments, stay. And if things are still bad, which means it goes beyond 3 quarters or even a year, that's when we start taking out.
So Prateek, your thoughts as we wind down the equity part of this conversation. What are you advising your clients right now? What sort of equity exposure to take, primarily large cap? Are you looking at some contra ideas, as Ashish just mentioned?
See, when we are constructing the whole equity portfolio, what we do is that we have a strategic allocation. That means for, let's say, a balanced investor, we've got about 60-70% of his allocation which is actually going into a into a large cap universe. The remaining 20 to 30% is where you could take exposure through whether it's in the mid cap, small cap or the sectoral space. So it could be a diverse mix of some of these strategies which we could look at. For especially the HNI space, some of the portfolio management schemes which are run with specific mandates also find a role in the 20-30% of the equity exposure which comes in. So in a way we believe that, I do agree with what Gaurav is saying, that you need to be consistent and stick to that mandate which is there. There could be periodic performance, underperformance which does not really dictate your transfer from one fund into the other fund. But largely we would again stick to the well-known performing funds with a much longer track records.
All right, gentlemen, thank you so much. Now that's the end of the equity part of this conversation, but we have a lot more to talk about, so keep it with us because this conversation continues next week. We will discuss where else you should be investing beyond equity. Will real estate finally start yielding some returns? Should you have a little bit of gold in your portfolio? What about other asset classes like perhaps art? All that and more will come up next week. So keep it with Money, Money, Money.